The United States government currently owes $37 trillion. That's more debt than any nation has accumulated in human history. To put this in perspective, this amount exceeds the entire global economic output from just 2 decades ago. But here's what most people don't understand. The government isn't planning to pay this debt back through traditional means. They're planning to eliminate it through a sophisticated financial mechanism that most Americans won't even notice until it's already happened. The strategy involves something called strategic reserve revaluation, a process where the government revalues assets it holds, specifically Bitcoin and gold, to astronomically higher prices. When these assets are revalued upward on the government's balance sheet, it simultaneously devalues the dollar downward. This isn't theoretical economics. This is documented policy with historical precedent, and it's happening right now. In this video, we're going to examine the actual mechanics of how debt elimination through currency devaluation works, why it's the only mathematically viable solution to America's debt crisis, and what this means for anyone holding dollars or dollar-denominated assets. Before we dive into the specifics, we need to understand a fundamental truth about government debt that separates it from household or business debt. When individuals or companies owe money, they must pay it back with real economic value. This means working more hours, selling assets, cutting expenses, or generating additional revenue. The currency itself remains stable, and the debt must be serviced in real terms. Governments operate under entirely different rules. Because they control the currency in which their debt is denominated, they possess a tool unavailable to private entities. They can change what the currency is worth. This isn't about printing physical money, or even traditional monetary policy. It's about redefining the purchasing power of the currency itself through asset revaluation. When a government revalues strategic assets on its balance sheet, it creates value that technically offsets debt without ever making a payment. This process is called a monetary reset, and contrary to popular belief, it's not a rare occurrence. It has happened repeatedly throughout modern economic history. The most relevant historical precedent occurred in the United States during the 1930s. Following World War I and during the Great Depression, the United States faced a debt-to-GDP ratio of approximately 40% and climbing. The economy was experiencing severe deflation, which made debt burdens even heavier in real terms. President Franklin Roosevelt implemented a radical solution that serves as the template for what's happening today. Here's exactly how it worked. In 1933, gold was officially priced at $20.67 per ounce. This price had remained constant since 1879, meaning for 54 years, the dollar was defined as 1/20th of an ounce of gold under the gold standard. Your dollar was literally a legal claim on physical gold held by the government. However, with debt burdens becoming unsustainable, Roosevelt issued Executive Order 6102, which made private gold ownership illegal. American citizens were required to turn in their gold to the government at the official price of $20.67 per ounce. Most Americans complied, trading their gold for dollars. Then, after the gold had been collected, Roosevelt announced a new official gold price in $1,934, $35 per ounce. This represented a 69% increase overnight. The economic impact was immediate and profound. The United States government, now holding most of the nation's gold after confiscation, saw its gold reserves jump in value from approximately $4 billion to $6.8 billion. They had created $2.8 billion in value simply by changing the official price. But more importantly, because the government's debt was denominated in dollars, and those dollars were now worth less relative to gold, the real debt burden decreased substantially. Within 5 years, the debt-to-GDP ratio fell from 40% to 25%, effectively erasing 15 percentage points of debt through currency devaluation. The American citizens who had turned in their gold at $20.67 watched it get revalued to $35, but they couldn't purchase it back because gold ownership remained illegal. They were left holding dollars that had lost significant purchasing power. Over the following decade, this devaluation resulted in Americans losing approximately 40% of their purchasing power. The government had successfully transferred wealth from dollar holders to debt elimination. This historical event isn't ancient history. It's the documented playbook being deployed again today. Fast forward to today, and the United States faces an even more severe debt situation. The current debt stands at $37 trillion, with a debt-to-GDP ratio of 132%. This is higher than any point in American history except during World War II. What makes this particularly concerning from an economic standpoint is the interest payment burden. The annual interest payment on this debt has reached $1.2 trillion. To put this in context, this exceeds the entire defense budget, exceeds Medicare spending, and is larger than any federal expenditure except Social Security. With interest rates remaining elevated, economic projections show that if rates stabilize around 5%, annual interest payments will reach $1.8 trillion by 2027. That represents 6% of GDP going purely to interest payments, not principal reduction, just interest. The Congressional Budget Office, the Treasury Department, and the Federal Reserve have all analyzed this situation. Their internal projections all reach the same conclusion. There is no scenario where this debt gets paid back through traditional fiscal means. Let's examine why conventional solutions won't work. You cannot tax your way out of 132% debt to GDP when raising taxes would slow economic growth, which reduces tax revenue. You cannot grow your way out when the debt itself is expanding faster than economic growth. You cannot cut spending sufficiently when interest payments alone consume 6% of GDP and are projected to grow. Every traditional path leads to an economic dead end. This leaves one mathematically viable option: devaluation. However, if the government simply printed money to pay debt, it would be obvious to everyone. Inflation would spike immediately, the dollar would crash in foreign exchange markets, and confidence in United States financial instruments would collapse. They need a more sophisticated approach, something that appears to be sound economic policy rather than currency destruction. This is where Bitcoin enters the picture. On January 23, 2025, President Trump signed an executive order establishing a strategic Bitcoin reserve. The order directs the Treasury Department to acquire and hold Bitcoin as a strategic asset, comparable to the Strategic Petroleum Reserve but for digital currency. The publicly stated rationale focuses on positioning America as a leader in digital asset innovation and ensuring the United States doesn't fall behind nations like China in cryptocurrency adoption. However, examining the economics reveals a different purpose. The United States government currently holds approximately 210,000 Bitcoin, primarily seized from criminal enterprises including the Silk Road Marketplace, the Bitfinex hack, and various ransomware investigations. At current market prices, around $100,000 per Bitcoin, this represents roughly $21 billion in Bitcoin holdings. While significant, this amount is insufficient to address a $37 trillion debt problem. The executive order doesn't simply direct the government to hold existing Bitcoin, it authorizes acquisition of additional Bitcoin. Senator Cynthia Lummis introduced the Bitcoin Act, which proposes acquiring 1 million Bitcoin over a 5-year period. At current market prices, this would cost approximately $100 billion. But here's the critical economic mechanism. They're not planning to acquire Bitcoin at current market prices through open market purchases, which would drive prices up substantially. Instead, acquisition occurs through seizures from ongoing criminal investigations, accepting Bitcoin as payment for regulatory fines and penalties from cryptocurrency companies, and potentially through government-operated mining using federal energy infrastructure. The accumulation happens quietly because the goal isn't to buy Bitcoin at today's prices. The goal is to accumulate Bitcoin before revaluing it. Here's how the revaluation mechanism would function economically. Assume the United States acquires 1 million Bitcoin over 3 years, at an average acquisition cost of $120,000 per Bitcoin, totaling $120 billion in acquisition costs. By 2028, they hold 1 million Bitcoin without announcing exact totals or acquisition methods. Then comes the announcement: the United States Strategic Bitcoin Reserve is operational, holding 1 million Bitcoin, and for purposes of the United States government balance sheet, Bitcoin will be valued at $1 million per coin. Not the current market price of $100,000, but $1 million, representing a 10 times revaluation overnight. This creates immediate economic effects. Their 1 million Bitcoin, acquired for $120 billion, is now valued at $1 trillion on the government balance sheet. They've generated $880 billion in balance sheet value simply by changing the accounting price. But this isn't merely accounting fiction. Once the United States government, as the largest Bitcoin holder, declares Bitcoin worth $1 million for reserve purposes and backs this with the full faith and credit of the United States. Market forces respond. Bitcoin doesn't reach $1 million immediately, but markets begin repricing toward this level. If the government sets the floor at $1 million, the market moves to $300,000, then $500,000, then $800,000 over the following year. The government's balance sheet valuation becomes economically validated by market movement. If you're enjoying this breakdown of how strategic reserve revaluation works as an economic mechanism, definitely subscribe to the channel if you haven't already. We're going to be covering more economic policy analysis and financial system changes as they develop. Bitcoin alone provides insufficient balance sheet impact to address $37 trillion in debt. This is where gold becomes crucial to the strategy. The United States government officially holds 8,133 metric tons of gold, approximately 261 million ounces. At current market prices around $2,800 per ounce, this represents $731 billion in gold reserves. While substantial, this barely makes a dent in the debt burden. However, here's the critical detail. This gold is valued on official government books at $42.22 per ounce. Not $2,800 at market prices, but $42.22. This is the official statutory price established in 1973. On the books, United States gold reserves are worth only $11 billion, not the $731 billion they're worth at market prices. This enormous discrepancy exists deliberately because it provides massive room for official revaluation. Here's what happens economically when they execute the gold revaluation. The United States announces a new official gold price, not the current market price of $2,800 per ounce, but $20,000 per ounce. Why specifically $20,000? Because at that price point, the mathematics work for debt offset. At $20,000 per ounce, the 261 million ounces of United States gold reserves become worth $5.2 trillion. Up from $11 billion on the books, they've just created $5.2 trillion in balance sheet value. Now combine the two strategies. 1 million Bitcoin valued at $1 million each equals $1 trillion. 261 million ounces of gold at $20,000 per ounce equals $5.2 trillion. Total balance sheet value created through revaluation, $6.2 trillion. This $6.2 trillion in newly valued assets technically offsets debt on the balance sheet. It doesn't pay off the debt, but it improves the debt to GDP ratio, makes the balance sheet appear stronger, and makes the government appear more solvent. But here's where the real economic impact occurs. Once gold is officially revalued to $20,000 per ounce by the world's largest gold holder, markets respond. If the United States government says gold is worth $20,000 and backs this with policy, market prices adjust accordingly. Gold doesn't hit $20,000 overnight, but it moves to $5,000, then $8,000, then $12,000 over subsequent years. As gold rises toward $20,000 and Bitcoin rises toward $1 million, the dollar is simultaneously being destroyed in purchasing power terms. This is the crucial economic concept that most people miss. When gold goes from $2,800 to $20,000, the dollar has lost 85% of its value relative to gold. When Bitcoin goes from $100,000 to $1 million, the dollar has lost 90% of its value relative to Bitcoin. The revaluation of assets upward and the devaluation of currency downward are not separate events. They are the exact same event viewed from different perspectives. The average American doesn't think in terms of gold prices or Bitcoin prices. They think in terms of grocery prices and rent payments. But those prices are directly impacted by currency devaluation. When the dollar loses 85 to 90% of its value relative to hard assets, it loses 50 to 70% of its value relative to everyday goods and services. Food prices, energy costs, housing expenses, everything increases proportionally. Let's examine this in concrete terms. Someone with $100,000 in savings today might feel financially secure. After the government revalues gold to $20,000 and Bitcoin to $1 million, inflation accelerates to 20% annually over 3 years. This isn't the official consumer price index, which uses substitution methods and hedonic adjustments. This is real inflation in actual prices. Food prices double, gasoline prices double, rent increases 60%. That $100,000 in savings now purchases what $35,000 purchased 3 years earlier. They've lost 65% of their purchasing power. Meanwhile, the government's debt remains $37 trillion in nominal terms, but in real terms, adjusted for the inflation they deliberately caused, it's worth only $13 trillion. They've erased $24 trillion in real debt burden, not by making payments, but by devaluing the currency the debt is denominated in. They've transferred $24 trillion in wealth from creditors, savers, and dollar holders to themselves in the form of reduced real debt obligations. Based on current policy developments and economic projections, here's the likely timeline for how this unfolds. The year 2025 represents the accumulation phase. During this period, the United States quietly acquires Bitcoin through seizures and strategic purchases without announcing total holdings. They avoid open market purchases that would drive prices up. Gold reserves remain constant, but policy discussions increasingly focus on gold backing, sound money principles, and strategic reserves. The narrative is being established. The year 2026 brings the crisis phase. Debt ceiling negotiations become increasingly severe, with the United States government facing potential default or shutdown scenarios. The bond market begins showing stress indicators with yields spiking. Economic confidence wavers. This crisis creates the political justification for extraordinary measures. In times of crisis, governments can implement policies that would be politically impossible during normal times. The crisis provides the necessary excuse. The year 2027 marks the revaluation phase. The government announces the strategic Bitcoin reserve is fully operational, holding 1 million Bitcoin valued at $1 million per coin for balance sheet purposes. Simultaneously, they announce a return to partial gold backing, with the dollar backed by a percentage of gold reserves. Gold gets officially revalued to $20,000 per ounce for reserve purposes. This gets marketed to the public as stabilizing the currency, restoring confidence in the dollar, and ensuring American financial leadership. Many people buy this narrative because it sounds strong and responsible, the opposite of money printing. But economically, here's what's actually happening. Bitcoin moves from $100,000 to $1 million over 12 to 18 months. Gold moves from $2,800 to $20,000 over the same period. The dollar loses 70% of its purchasing power. Inflation doesn't hit 10% annually, it reaches 30%, possibly 50% in the first year. Food prices triple, energy prices quadruple, housing prices double in nominal terms but fall in real terms because affordability collapses. The economy enters stagflation, high inflation combined with low growth. Unemployment rises to 8 to 10%. Every major economic transformation creates winners and losers. Let's examine who benefits and who suffers from this debt elimination strategy. The clear winners include the United States government, which erases $25 trillion in real debt burden without defaulting. Politicians avoid the political pain of either spending cuts or tax increases. The Federal Reserve maintains control over the monetary system. Early Bitcoin holders who acquired Bitcoin at $30,000 or $50,000 and hold through the revaluation to $1 million see massive wealth increases. Similarly, early gold holders who purchased at $800 or $1,200 and hold through revaluation to $20,000 preserve and multiply wealth. Foreign governments with substantial gold reserves, including China, Russia, and India, see their gold holdings revalued as well. They can use the same mechanism to erase their own debt burdens. Wealthy individuals holding real assets like real estate, stocks, and businesses see those assets inflate in nominal terms, preserving wealth through the transition. The losers face severe economic consequences. The middle class, particularly people with savings in dollars, get devastated. Retirees on fixed incomes watch their purchasing power evaporate. Bondholders, especially those holding United States Treasury bonds, get repaid in dollars worth 70% less in real terms. Pension funds holding massive amounts of government bonds see those bonds become worthless in real terms, leading to pension collapse. Workers find wages don't keep pace with inflation, with real wages falling 40 to 50% and living standards collapsing. Renters face landlords raising rents to match inflation, while wages stagnate, leading to people being priced out of housing. Small businesses that cannot raise prices quickly enough to cover increasing costs see profit margins collapse and failure rates spike. This isn't purely a domestic United States policy. For the strategy to work effectively, there needs to be at least implicit international coordination. The BRICS nations, consisting of Brazil, Russia, India, China, and South Africa, have been discussing gold-backed currency alternatives for years. They're preparing for diminished dollar dominance and have been systematically accumulating gold reserves. China officially holds 2,300 metric tons of gold, though analysts estimate actual holdings between 4,000 to 6,000 metric tons when including unreported purchases. Russia holds 2,300 metric tons officially. India holds 840 metric tons and continues purchasing. These nations are positioning for a monetary reset by accumulating the hard assets that maintain value when fiat currencies collapse. When the United States revalues gold to $20,000 per ounce, it's not solely a United States policy decision. It becomes a global repricing event because gold trades in global markets. If the United States declares gold worth $20,000, China declares it worth $18,000, and Russia declares it worth $22,000, global market prices settle somewhere within that range. Everyone's gold reserves get revalued. Everyone's debt gets devalued in real terms. This represents coordinated reset, not through explicit international agreements, but through implicitly aligned incentives. Every major government faces the same fundamental problem: mathematically unpayable debt levels. And every government sees the same solution: devaluation through hard asset revaluation. World central banks bought over 2,000 metric tons of gold in 2022 and 2023 combined, the highest level since the 1950s. This isn't coincidental. They're observing the same economic mathematics and positioning accordingly. Let's translate the macroeconomic theory into concrete impacts on everyday life. When the dollar loses 70% of its purchasing power over a 3-year period, here's what it looks like in practical terms. A grocery bill that costs $200 today costs $600 in 3 years. Gasoline at $3.50 per gallon goes to $10.50 per gallon. Rent at $1,500 per month increases to $4,000 per month. Healthcare costs, already expensive, become prohibitive for many families. But wages don't increase proportionally. If you're earning $60,000 annually now, you might be earning $75,000 in 3 years, a 25% increase. But prices have increased 200%. Your real wage, what your income actually purchases, has fallen by more than half. You're working the same job, putting in the same hours, but you can afford less than half of what you could before. This is how currency devaluation destroys living standards while being invisible to people who don't understand monetary economics. Savings accounts offer no protection. If you have $50,000 in a savings account earning 4% interest, you'll have $56,000 in 3 years. But that $56,000 purchases what $19,000 purchases today. You've lost 62% of your purchasing power despite earning interest. The interest rate doesn't come close to keeping pace with real inflation. This is why holding cash or dollar-denominated savings through a currency devaluation event is economically devastating. The strategy we've examined isn't speculation or conspiracy theory. It's documented economic policy with clear historical precedent. The United States executed exactly this strategy in 1933 through gold revaluation. The executive orders establishing strategic Bitcoin reserves are real policy signed in January 2025. The Bitcoin Act, proposed by Senator Cynthia Lummis, is actual legislation currently being considered. The mathematics of the debt burden are undeniable. $37 trillion in debt, 132% debt to GDP ratio, $1.2 trillion in annual interest payments, growing to $1.8 trillion by 2027. When debt reaches levels this extreme, devaluation becomes the only mathematically viable option. The government cannot tax enough, cannot cut spending enough, and cannot grow the economy fast enough to service this debt through traditional means. Every government throughout history facing similar debt burdens has chosen currency devaluation. The United States chose it in the 1930s. Weimar Germany chose it in the 1920s. Argentina has chosen it repeatedly. Zimbabwe chose it in the 2000s. Venezuela chose it in the 2010s. The pattern is universal because the mathematics are universal. The sophistication of the current approach lies in the branding. They're not calling it money printing or currency debasement. They're calling it strategic reserve management, return to sound money principles, and national security asset positioning. But the economic outcome remains identical. Assets held by the government get revalued dramatically upward, creating balance sheet value that offsets debt while simultaneously devaluing the currency downward, destroying purchasing power for everyone holding dollars. This economic transformation is already in motion. The pieces are moving into position. The policies are being implemented. The timeline points to 2026 through 2027 for the revaluation phase. Understanding these economic mechanisms doesn't mean you can stop them from happening, but understanding does provide the opportunity to position accordingly, to hold assets that preserve value through currency devaluation rather than assets that get destroyed by it. The economic reset is coming. The only question is whether you'll be positioned on the side that preserves wealth or the side that loses everything.